Hello friends, we have made so many articles on stocks fundamental analysis and technical analysis and also made so many podcasts on stocks technical and fundamental analysis. However, some of our friends suggest that you should come with a simplest system to doing stocks fundamental analysis. So, on your demand, we have come up with a simplest system of doing stocks fundamental analysis. So to do that we have made a system, and that system is governed through a notebook. In that notebook you have to record the date on which you are doing the fundamental analysis, then the stock name, its price at that point, and the quantity you bought at that point, stocks volatility ratio, which we also say beta, and then the stocks P ratio and the sector P ratio. The stock P ratio is the price to earning ratio of any stocks, and sector P ratio is the price to earning ratio of that particular sector in which your stock is belonging, in which your company is belonging. Then price to book ratio, PB ratio, and sector PB ratio. Then another thing is dividend yield versus sector dividend yield. Then market cap, 5-year historical revenue growth, 5-year historical operating cash flow growth, 5-year historical earning per share EPS growth, 5-year average return on investment, 5-year average return on equity, debt to equity, enterprise value versus free cash flow, price versus free cash flow, 5-year CAGR, promoter holding, promoter pledge ratio, technical analysis, that is 5-year trend versus 5-year return, uptrend, downtrend, sideways. All of these you can track easily in a notebook, and that notebook gives you a system to do a stock fundamental analysis in very simplest method. And to do this you have to give a very small time, 2 to 3 hours in a day of within a month. Not have to involve all the month, all the days in doing investing, but you have to select, or you have to a day particularly in that month on which you have to take some time of 1 hour to do this fundamental analysis, and the values of the particular stock you want to do fundamental analysis, you have to record this notebook. Then this notebook give you a system to find the best performing stocks, the worst performing stocks, the multi-bagger stocks. So if you wish to do the fundamental analysis to find the best performing stocks which gives you good results in upcoming future, and if you want to search for a multi-bagger stocks which can turn your life and which is become a turning point in your life, then this notebook or this system of doing fundamental analysis is very good for you. So before going forward, first we understand these ratios and their importance. So after that we will give you that notebook. So first of all, this notebook come with a 30 plus stocks. So you have not to do invest in many stocks, you have to do diversification of your stocks, of your portfolio to about 20 to 30 stocks. So you have to select the past 20 to 30 stocks which you think become good, but make sure these stocks are from different sectors, or maybe 5 to 10 stocks from one sector, then 5 to 10 stocks from another sector, then 5 to 10 stocks from another sector. But overall your portfolio should have minimum 4 to 5 sectors. So pharma is a sector, and then electronics is another sector, then consumer goods another sector, FMCG another sector, and defense another sector. So these are banking and other sector. So these are sectors. So you have to select any sector which you think grow in the upcoming future. Then you have to find the best companies in that sector, or vice versa. First you have to select the companies and identify their sectors, but you should have at least 4 to 5 sectors and minimum 15 to 20-30 companies in your system of stocks fundamental analysis. Then you have to do something, and that is you have to after finding the sector, you have to list the name of your company and its sector in which it's belong, and then you have to find the market cap of that company. And now question come up with how I can find the market cap of that stock. So to find the market cap or all values I will discuss in this podcast, you get the values of all these ratios from some websites like screener.in or TickerTab, Zerodha Kite, or any broker in which you are investing. They provide you these values, or if they don't provide, then there is so many websites on the internet which can provide these values of a particular sectors or a particular company. So don't worry about that. So for that, first you have to find the company and its sector. Then you have to find the market cap of that company on that particular day on which you are finding the ratios of this company or doing the fundamental analysis. So on that particular day, what is the market cap of that company, you have to write down, and then the price on that particular day, then the quantity on that particular day in your portfolio. So you have to find the price on that particular day, market cap on that particular day, and you have to write down the quantity on that particular day and the current return that stock is giving to you on that particular day. You have to write down that, and after that you have to write down the beta value. Beta is stocks volatility ratio that you can easily find from your investing app, from any internet website like screener.in or any other website. Then you have to find the P versus sector PE. So PE is price to earning ratio and sector PE is price to earning ratio of that particular sector. Then PB versus sector PB ratio, debt to equity ratio, earning enterprise value versus free cash flow ratio, price versus free cash flow ratio, dividend yields versus sector dividend yield ratio. So these are so many ratios which you find in that system, in that notebook, and you have to return the values of this ratio, and after that on the next month you have to repeat the same process. Means the next month you have to write the date, market cap, price, quantity, these values of these ratio in the notebook. So after doing this for some couple of months, you find that in 6th to 7th or 10th month you find that there is a system which shows you the some ratios are going in your direction and some goings are opposite of your direction. So from there you can find that the particular stocks which are going in your direction. So don't worry, I explain you what is your direction. So the stock values which are going in your direction, that is the favorable stocks for you. And that's, if you see the all ratios suggest that they are going in your direction, means that stocks is going to become a multi-bagger stock. And if only few ratios are going in your direction, means that is a good stock. But maximum ratios, about 60-70% ratios going in your direction, means that is a good investment and it gives really good returns. But if you see few ratios are going in your direction but maximum ratios are going in opposite of your direction, then you should have to take care of that stock, because it may not go as per your choice and you have to exit from that stock as soon as possible. So first we have to define what is your direction. So for that you have to select the stocks which show the stock volatility ratio very less. So beta of any stock should be less, so there is very less fluctuations in that stocks, so you have to don't worry about that. So you should always select that the stock volatility ratio should be less. Then PE versus sector PE, or price to earning ratio versus sector price to earning ratio, this should be less. So if the price to earning ratio versus sector price to earning ratio is less, then it is good. If it is going upside in upcoming months, then you have to eye on it. So you have to track on it. You have to find that why it is going upside. Is really company future is very good, so many persons are attracted towards it, then it's good. Otherwise, if there is not a forecast about the good returns, good output of the company, then this ratio should be dangerous. So price to earning ratio versus sector price to earning ratio should be less. Similarly, price to book ratio versus sector price to book ratio should be less. And another ratio, that is dividend yield versus sector dividend yield, this should be high. Dividend is the actual thing that you get from your investment. So this is something like which is your return throughout your investment journey. So dividend is the extra money that you get in your pocket for your enjoyment in your life. And if you don't want dividend, then you should have to reinvest that dividend. But stocks dividend yield versus sector dividend yield should be high. Similarly, market cap should also be high, because the companies with high market cap are reliable, have the vision of future. So you have to invest in big market cap companies. So stay away from the small cap companies or risky companies. Although you can invest in some small cap companies with good vision, good future and good current ratios, but that should be about 5 to 10% of your portfolio. Not invest more than 10% in small cap companies, small cap funds. Another ratio is 5-year historical revenue versus revenue growth. So 5-year historical revenue growth should be high. Means in the last 5 months company gives good revenue growth. So 5-year historical revenue growth should be high. Similarly, 5-year operating cash flow growth should be high, because operating cash flow is the money that is very important for any company to operate. So this should be high, because if company have the free cash flow, operating cash flow, then the company run its business very easily. If the company is struggling with the operating cash flow, then there is something bad may happen in the near future. So 5-year historical operating cash flow should be in the growing phase and it should be high. Similarly, 5-year historical EPS, earning per share growth. So from the last 5 years, companies should show the EPS growth. So 5-year historical EPS growth is a good ratio which suggests that company is growing, company have good vision, company has growth prospects. So this ratio should also be high. Similarly, 5-year average return on investment and 5-year average return on equity, this should also be high, because these suggest that the company is in the growing phase, company gives you good return on your investment, on your equity. And another important ratio is debt to equity. Debt is the loan on the company which is killing your company. So this ratio, debt to equity ratio, should be less or zero. We suggest you have to select the companies with debt to equity ratio very low or almost zero. So if your company have debt to equity ratio very low or zero, then it is a very good company and it's do not struggle in near future. As we all see in the COVID, only that companies survive which have zero debt, and other companies do not survive. Many companies with big debt shut down because of debt. So debt to equity ratio should be very low or almost zero. Similarly, enterprise value versus free cash flow or price versus free cash flow ratio should be less or should be very low. So before going forward, we have to learn what is price to free cash flow. So price to free cash flow is an equity valuation ratio that indicates a company ability to continue operating. So this ratio gives you the company ability that it can continue its operations in near future. It is calculated by dividing its market capitalization by free cash flow it have relative to competitor business. A lower value for price to free cash flow indicates that the company is undervalued and its stock is relatively cheap. This ratio is used to compare a company stock value to its cash management practice over time. So simply we can say that this ratio is very important ratio, and earning enterprise values versus free cash flow or price versus free cash flow should be less. Similarly, promoter pledging. So pledging is that promoters of the company have some shares in the company, and the promoters pledge its share in the bank. So that is not the good sign for any company. So promoter pledging should be zero or almost very less near zero. So you have to select the companies which earning per enterprise values versus free cash flow or price versus free cash flow and promoter pledging very low. And now is 5-year CAGR. CAGR is compounded annual growth rate. So you have to invest in the companies which showing good compounded annual growth rate. So from last 5 years, companies should show a good growth. So you have to select the companies which have higher 5-year CAGR, and in your journey of tracking the stocks, doing fundamental of stocks, your ratios month by month, quarter by quarter or year by year showing the 5-year CAGR growth increasement. So next thing is technical analysis. So in technical analysis, we see 5-year trend, 5-year returns, and they should be in up, down or sideways directions. So it is always suggest that your 5-year returns or 5-year trend should be in upward direction, not in downward, not in sideways. So if company have 5-year trend if in upward direction and 5-year returns good, very good, then that is company is very good. So we can simply say that companies should be in uptrend with good returns. So these are some ratios which you can track on monthly basis, and write down their values in your notebook system, so you can get the results that your stock is growing. And from after doing this system for 5 to 6 months, you can find that some of your stocks going in your direction. In your direction means as we suggest in our discussion, that the dividend yield versus sector dividend yield is going upward, market cap is going upward, stocks historical revenue growth, operating cash flow growth, earning per share growth is going upward direction, stocks is in uptrend with good returns. So these are your favorable direction. Similarly, enterprise value versus free cash flow, price versus free cash flow, promoter plays, P versus sector P ratio, PB versus sector PB ratio going downward directions, means these are your favorable ratios. So if your stock showing you favorable ratio, then that is a awesome thing. Then you can find the stocks with your direction, means your stocks give you very good returns. So you have to track all these in a notebook, and you can purchase that notebook from Amazon.com, and we give you the link of that notebook system in this podcast description. From there you can purchase that notebook, or even you can make a notebook at your home by yourself. So choice is yours. We have made a very good notebook to track all these systems, and which you can purchase from Amazon.com. The name of the notebook is Stocks Fundamental Analysis Investing Notebook, with historical records of debt, growth and valuation records. This notebook is available at Amazon.com, and this is a very good notebook with about 65 pages, in which you can record 30 plus stocks, and you made a system of doing fundamental analysis. This notebook acts as a portfolio manager and record to track and find best performing stocks for stock market investors. So thank you friends. This is our podcast on doing fundamental analysis of any stock in a systematic manner by recording their values and understanding that values with yourself, not by listening others, by watching videos on YouTube. You have to make your own system and understand the returns, the values of your company, how your company is performing. Is it in good direction or bad direction? Is it in uptrend, downtrend, sideways? How your stock is performing, how your company is performing, what is the vision of your company, how much debt your company have, how much returns your company generate. All these things you can easily find with this system. So thank you friends. See you in next podcast. If you find this system valuable for you, if your system working for you, please reply us on this podcast link. And if you want to do investing seriously, then make your own system with the help of this notebook, which you can get from the description of this notebook. Thank you. See you soon next time in the next podcast with the awesome investing strategies.